That's a strong light.
Yeah. Woof.
No, it's us as well. Like really strong.
I know it.
Good afternoon, everybody. I'd like to welcome you to deep dive number 5, Scaling Digital Climate Markets with Integrity. And I'd like to introduce our panelists here today. We've got Michael Sheeran from Metaverse Green, Mustafa Ali Khan from Climate Connect Digital, Adam Shadesli from Flow Carbon. We've had a slight change, and we now have Ken Griggs from Chia Network and Jacopo Vizetti from IETA. I mean, I'd just like to introduce or invite all of you to give a kind of 2-minute spiel in terms of where you've come from and why you're here today.
Well, thank you. It's a real pleasure to be here. And I was just saying, some of the content that I've heard in some of the earlier sessions has been extraordinary. Looking forward to the contribution here. Again, my name is Michael Sheeran. I'm with MVGX, which is a digital green exchange based here in Singapore. But I'm fairly new to the company. Prior to that, for the last 10 years, I was a senior advisor to the Bank of England, leading the sustainable finance and their digital operations. Also chaired the G20 on the sustainable finance. And so I'm deeply involved both in policy, on the markets, as well as on the tech side. So I think in today's panel, I'll probably wear all 3 of those hats and let some of my esteemed colleagues here maybe lead on the tech, and I'll also try and bring the policy and the markets in as well.
Thanks. Myself, Mustafa. So I have been in this domain since 2002, starting off as a researcher, working in the forestry and carbon space. Then working into the markets as well with Climate Connect Digital from 2010 to 12. In the past 10 years, I was with the Swiss Agency for Development Cooperation and implementing bilateral projects in the space of climate change adaptation mitigation between India and Switzerland. So a lot of groundwork over there. Recently, I've shifted back to Climate Connect, the company which I left 10 years ago. Pretty excited to trying to connect the climate and carbon worlds with the digital worlds. So we do a lot of carbon consultancy, carbon advisory work, and we are also, as the name indicates, into the digital play of it. So trying to connect the 2 places. Thank you.
As I figure out how to use this mic, I'll just use my friends here. Adam Shadesli, I'm Director of Policy at Flow Carbon. My background is in the climate policy space as well as carbon markets. I spent a few years first actually launching a political advocacy organization. So really, we collect around 500,000 Canadians, I'm from Canada, and pushed politicians to enact more bold climate policy. So I come with that activist background. I also spent a few years as a senior policy advisor to the Minister of Environment and Climate Change and the Premier in Ontario, where we had our linked cap and trade system with Quebec and California that unfortunately no longer exists, was scrapped by the forthcoming government. And I spent the last year and a half in the voluntary carbon market. So I'm Flow Carbon's Director of Policy, and what Flow Carbon does is our mission is to make carbon markets more transparent and accessible and enable the early flow of financing to project developers who need it to start carbon projects. So we're active across the value chain. In the project origination space, we're partnered with Alcott, for example, where we're doing a blockchain native project, through to financing, where we work with a centrifuge protocol to give project developers and investors new opportunities to invest efficiently at a low cost of capital, through to DMRV, where we have several partnerships, as well as tokenization of carbon credits I want to speak a bit about today. So really looking forward to the conversation.
My name is Ken Griggs. I am with Chia Network. I come from a sort of a different background than a lot of the folks here. I am long been in technology. Started out writing code. Went and got an MBA. Went and joined Deloitte, delivering software for them, and then came to Chia Network. So we are Chia Network has a blockchain. But I've been working to provide to use that blockchain to provide the backbone for the Climate Action Data Trust, to help provide transparency across all of the registries as sort of a meta registry or metadata platform for all of the carbon projects.
Thank you. My name is Jacopo Vizzetti, and I'm with IETA. We are a carbon trader and a carbon project developer. Myself, I've been in the space since 2008, and then co-founded IETA in 2010, and we've been present mainly in Sub-Saharan Africa to develop projects over there since 2012. A couple of years ago, we started approaching blockchain space to see how this technology could actually help from a perspective as a project developer to leverage both potential on-chain finance as well as transparency for carbon markets in the project development space. And I guess that's why I'm here today.
Thank you. Maybe, Michael, I'd like to turn it to you at this stage and ask if you can perhaps set the stage for the audience in terms of the current state of the market, your perspective having entered the market from a long history in financial markets, and perhaps some of the challenges that you kind of have identified more recently.
Okay, happy to do that. I mean, the one thing is everyone here knows is the carbon markets aren't new. They've been around for 20 years. They've evolved. People know quite a bit about them. However, to really scale them, and that's one of our goals here in using technology and integrity, really needs something that can allow standard markets to move beyond that. So if you talk to the trading desks, the major investment banks, they're geared up. They've got people there. They want to work on it. But some of the issues that are outstanding, and many of them discussed here so far, are around the issues around integrity, around standards, and how do those progress. I'm sure many of you were at the COP meetings a few weeks back, and IOSCO has a paper out on the voluntary carbon markets as well as on the compliance markets, on how do we start making carbon part of the architecture of the financial markets. Because if you're looking to start scaling, you need to have standards, you need to have documentation. Any of you that have been in the debt capital markets, if you've done derivatives, commodities, debt capital markets, equity capital markets, these are some of the things. So if you ask a trader at an investment bank, oddly enough, they're asking for regulation, they're asking for codification, they're saying, how can we bring this up? And so I would argue that's probably one of the most important elements from a market's point of view, being able to determine that. If all of you collectively owned or had a concession on 100,000 hectares of rainforest right now for 50 years, this year's are crystallized. They're actually a commodity of sorts. But the other 49 years are claims on future sequestration. So effectively, it's a derivative. And so making sure you've got ISDA documentation that can work and go across globally, because scale is a global market, and trying to make carbon a global market that market participants, both existing ones, know how to use, know how to work, have confidence in the system is absolutely essential. So the good news is, and again, I do have also another position within the UNDP and their Sustainable Finance Hub, and so sitting down in some of the closed-door sessions with people like IOSCO, that's an active piece of work that's moving. For all of us in this room, it's things that just can't happen quick enough, because that's what's going to start giving you the ability to deploy market participants and make them move. The scaling also, as we talked about, is around digitization, and I'm going to let some of my colleagues address that a little bit more in detail, though MVGX is completely about digital markets, digital exchanges, and we're regulated. And I guess that's what it comes down to, is being able to bring it into the marketplace is regulated. And I guess the last area is around the policy, and we were talking about this beforehand. There's some things that none of us in this room can do yet. We need to have this happen, and that's around standards. There's easily 26 major standards around carbon credits globally right now, and everyone agrees there should be one threshold standard. Unfortunately, I tend to always agree it should be theirs. You've got the ICVCM, which is obviously working, but they're in a tough spot. They're not a private sector, or they're not a person who does it. And then you've got the UN, who's actively working on this as well, but they probably won't come out with standards until 2025. So what do we do between now and then? I mean, what we're advising clients is to use the highest possible standards depending on what the particular carbon generation activity is, whether it's mangroves, rainforests, and things of that sort, because we probably won't have that base threshold till then. And being able to partner up those policy pieces, also thinking about how the registries work. Registries are the same as standards. everyone thinks it should be their registry, whether it's a meta one, whether it's a sovereign one, or whether it's a private sector one. So being able to have that communicate, you basically need a Rosetta Stone, and there are some companies that do that different blockchains can talk to each other, because if you've got registries all over the world and they're not communicating, one of the big problems is, are we double counting? So just to kind of bring these together, you've got the market participants that are very much driving and wanting a regulated, codified financial markets instrument that can drive scale. The policy people who definitely want to bring the policies in, but the policies are moving slowly, and they've got competition out there, and they're not moving to the point till easily 2025, 26. And then we've got, which will probably kick off our digital conversation, if those two things start really coming together at pace and scale, how can we use digitization to really ramp it up and start using things like transparency that you get in a blockchain or a digital type of ledger, and the things that you can show in terms of integrity as well. So in short, we're not quite there yet. We're getting there, and I'm looking at friends in the audience who have been doing this for 20 years, and we're getting close, but we're still not quite there yet as a market.
Fantastic. Thanks, Michael. That's incredibly helpful. Maybe, Adam, I'd like to turn to you at this stage. One of the big trends over the last year or so has been this drive to bring carbon on-chain and the tokenization of carbon credits. Flow Carbon has been one of the most vocal proponents of this technology. Would you be able to kind of explain what it is to many of the audience that perhaps are not familiar with tokenized carbon credits and the kind of value proposition that sits behind it?
Sure. Yeah, I can do that. Thank you for the question. So what is a tokenized carbon credit? So to start, a carbon credit is issued in a serial database, right, by Vera, Gold Standard, et cetera. What we want to do is we want to create a digital representation of that specific carbon credit via the form of a token, and allow the owner of a carbon credit to, instead of having to engage through intermediaries and not be able to directly access their end buyer, we want to give them a token that makes it easier for them to make choices, whether that's trading it, whether that is inserting it into a bundle that allows for more price transparency. So if you have a 2019 red credit from Indonesia, what is that worth? I don't know what that's worth. It's not a liquid enough market. Whereas as you get more and more tokens on chain, you can then have the lowest common denominator bundle. So you could have 2019 and 2020 red projects without CCB versus with CCB. Eventually, maybe you have AA credits versus AAA credits, and you make it a dynamic market that can be incredibly robust over time as you get more scale brought onto the on-chain market. So what's the benefit of this? Well, the increased price transparency, it does allow for more economics to go to the people who need it most, right? The local communities, to encourage them to not convert their land to agricultural uses, go to project developers to increase their economics, and it goes to investors so that there are more profitable projects and they invest more and more. One of the other really interesting things about tokenization is that it also can unlock new demand sources. And I think we should level set here for a minute in terms of what the market is at now versus where it needs to be, right? It's a $2 billion market. The UNEP suggested that the financing gap just for nature-based projects is $267 billion by 2030. So the VCM right now is a rounding error, more or less, on what needs to happen. So we need to be thinking about how do we create a lot of new demand. Is this going to be mostly driven by institutions, by corporates? Yes, it should be, but we don't know that for sure, right? Especially with net zero guidance through the SBTI, focusing on removals long-term, accusations of greenwashing. There's a lot of uncertainty in the market. So being able to unlock new demand sources, I think, is valuable, is a valuable contribution, something that should not be discounted. So what does that mean, unlocking new demand sources? We fully agree that carbon credits is not a retail investment opportunity that should be marketed as such. That's not what anyone is suggesting. But there's several new demand sources that can come from tokenized carbon credits. Number one, tokenized carbon credits can act as kind of smart programmable Lego blocks that can be automatically inserted very efficiently into a whole variety of use cases. Right? So automatically offsetting all wallet activity, automatically offsetting consumer purchases, being integrated into an ethical commodities platform called Water that's actually being developed by an Shell head of origination and investment, $17 trillion market. Flow Carbon is a partnership with them. We want everything to happen seamlessly and efficiently. And then individuals. Right now, if I wanted to buy a carbon credit for myself or for my family, I can't do that, right? I have to go to some intermediary, and I have no idea what the right price is to pay. Is it $18? Is it $11? I don't know. And I have to retire it right away. I can't hold it if I want to. We believe that in the planetary emergency that we're currently in, people deserve the opportunity to participate in this market if they choose to, with fully appropriate information guidelines, with disclosure, and it shouldn't be marketed as an investment opportunity. But there is real potential there. There's also Web3 protocols that have committed hundreds of millions of dollars to buying carbon credits, and we think there's just an incredible amount of innovation that could be unleashed as well through decentralized finance by this new innovation of tokenizing carbon credits.
Thanks, Adam. Maybe, Ken, at this stage, I'd like to turn to you. Chia obviously is a layer 1 blockchain. Beyond that, you've been intimately involved in the development of both the kind of climate warehouse broader ecosystem and the Climate Action Data Trust, which we'll be launching later today. Maybe you can talk to kind of the value blockchain brings in terms of connecting lots of independent registries globally, and your thoughts on that matter.
I would be happy to. So when you think of blockchain, you often think of tokens, right? And we've all thought of token trading and whatnot. And that's an important use case of a blockchain. But what a blockchain really is that it is a immutable database. It's a place to store data that cannot change. With tokens, that data is the who owns which token. But what's interesting about it is that each person has, or each participant in the blockchain has their own keys, and they own their own interactions with that blockchain, and nobody else can change it. So one of the things that we can do is that we can make it so that every participant can publish their own data out onto the blockchain, and that data is then fully auditable. It can't change. So when they update the data, we can all see what the updates are, and it will always be there. Additionally, we can make sure that that data is verifiable. So anytime if you have a copy of the data, you can go look on the blockchain and you can verify the data that you have is correct. The other important thing is that then you can be held accountable for that data. There is no one that is holding that data for you. There is no central server that is controlling the data. There's no one who can lose your data, delete your data. It's the data that you published, and that is the data that you own. That is important for anything that we're trying to manage globally. Right? There's a lot of countries that maybe don't want to work together directly. There's a lot of people who don't want to work together directly. But if each participant is able to publish their own data and is able to look at the data being published by others and hold each other accountable for the data that they publish, which is very much in line with the Paris Agreement, bottom-up ethos, then that is a perfect use for a blockchain to store data internationally. That is why we worked with the World Bank initially to help create the Climate Action Data Trust, which is a part of their larger climate warehouse program. I am delighted that it will be going live or get properly announced later today. And I look forward to seeing how that project is going to progress.
Thanks, Ken. Jacobo, as a project developer, you're intimately familiar with the challenges that the industry faces. Can you perhaps kind of give some examples of digital tools that you're looking at adopting to accelerate your projects and scale as the market needs to ahead of 2030 and 2050 goals?
Sure. So basically, I can talk more about basically our experience and how this could apply, I would say, across the board for project developers in the space. I would say that the first actual advantage that you see when you approach technology like blockchain and its application to potential project development, to the project development cycle, up to certification and then potential trading, is first of all really the transparency that it brings, but also the completeness of information. So as a project developer, you have two scopes. First of all, secure funding to develop the project in case you don't have it in the first place. And the second one is to be able to have marketable product at the end. So credits which have all the right things in the right place. So they need to guarantee integrity. You need to be able to audit those credits in an efficient way, transparent way. And also then, of course, if the credit is of high quality, and that you can prove even more by being transparent, you can sell it easier. So you have, I would say, two parts. The first one is securing funding, and the second one is be able to sell those credits to potential buyers. These things are not disconnected among themselves because no investor will want to put money in a project where they don't have visibility across the cycle of the development. And no buyer will want to buy a credit which is unauditable. So that's why we see the rising of companies which do, for example, credit ratings, right? Because there's not enough transparency. And so that's why there's use cases for companies who do actually ratings. But so when we first approached, let's call it the digital markets, crypto space, how some call it, to tap into a potential financial pool there, we first tried to understand how this could have helped us through the development phases. And I would say that what convinced us to go through was really the fact that we would not only tap into a different kind of liquidity pool, which has a way different speed of velocity in financial terms to actually deploy that capital towards the project, which of course doesn't hurt, especially if we need to reach certain goals by 2030, and we're already late, by the way. But on top of that, it gave us, let's say, certainty that we could actually demonstrate the different steps of the development of the project publicly. So not only, I would say, a certain type of standard could see what we were doing by the document we submitted, but also the whole community, which actually decided to potentially participate in the funding of the project, as well as the potential buyers. They could see how the project was advancing, where the difficulties were, and actually have a broad view of everything that was being done. So this created, I would say, a very confident environment for both the pre-buyers of the credits that we were about to generate, as well as for the partners which decided to fund. So it was really, I would say, a complete transparent process from inception till the sale of the credit. And this is something that's what's developing a project normally, I would say, without the use of leveraging the blockchain technology, we didn't have. And we see why, I think, at least in my experience, this has changed, and also the speed of investment. Because you can, as an investor, you're way more safer in investing in a project which has a transparent workflow in the deployment and the issuance of the credits than it is with a project which isn't leveraging this technology, because you can see all the steps. By leveraging smart contracts, you're also able to unlock finance only at certain milestones, right? So you could do this in traditional finance as well, but here you really have the way to prove it, right? The smart contracts are, I'm not going to dig into how smart contracts work, it's probably going to take too long. But the other aspect is also the fact that by allowing all this information to be so public, way more public than you would have on standard registries, what enables you is that you avoid one of the things that most of project developers fear the most, and also the buyers fear the most, which is the backfiring on potential, loopholes or potential problems on the original credits, baseline that changes, especially in deforestation rates, and nature-based solutions are kind of hard to monitor, but there's technologies now. But if you develop the project in a transparent way, you can also go back to the information you uploaded. And as you were saying, Ken, the information is immutable, so you won't be able to cheat there. There's no arguments, you know. And the single thing that we need to take away from this market is the potential arguments on the integrity of credits. And I think that for a project developer, this is the ultimate, I would say, insurance tool. So blockchain, to us, was an insurance tool as well as tapping into liquidity.
Fantastic. Mustafa, Climate Connect Digital has developed kind of suite of tools to help both project developers and investors within the space. Can you perhaps kind of explain these tools that you've developed and the value that they bring to the market?
Thanks, Alistair, for asking that question. Very enriching discussions over here. You know, I was hearing, I could connect to a lot of these points, you know, and I'll try and connect with what you all said over here. So, I mean, when you talk of digital tools, you know, and of course, Climate Connect Digital is making various tools. The whole idea is to, you know, to bring scalability. When if you're talking of scaling the carbon markets, it's impossible that we try to achieve those big numbers of, you know, 50 billion tons without getting into the digital space. It's too difficult for something to be done manually. You know, so that's the whole concept and idea behind what we're trying to develop. And also, you know, the whole idea is to save time, to save our headache for ourselves and for our clients as well, and of course to try to maximize the revenues part of it because we are in the private sector market. So those are some of the driving factors. So we are using digitization to achieve all this. The whole concept, you know, is that, for example, if you have one use case that we are working on is, for example, you are a project developer or you are an investor into carbon projects, and like you have 150 projects across the world spread across 10 countries, for example, some in NBS, some in renewable energy, some in modal shift, for example. How do you track these 150 projects across 3 registries, 15 methodologies, using Excel files, or maybe some commodity trading tools which you have customized for your own carbon trading purposes? So what we have done is, like, we have tried to develop our own tool where you can, you know, the entire carbon project portfolio can be uploaded over here, and the single tool will provide you with all these things in one single platform. We have also tried to integrate the exchange-based prices. We have also developed in-house models for risk, issuance risk, basically in the volumetric risk, what is the kind of risk that is associated with different stage of projects, based on whether they are RE or whether they are NBS projects, for example. So that's also part of this tool. So that's one of the offering. Besides that, like, we have a very deep roots in the RE space, in the renewable energy space. So over there, you know, we do 15-minute forecasting for renewable energy plants. We have like almost like 12 gigawatts of capacities for which we do this 15-minute forecasting. So every 15 minutes, we give forecast as to what is the amount of renewable energy which is going to be produced in the solar and wind farms. So this is something which goes to the national grid then, so that they can make their adjustments for renewable versus non-renewable supplies. So that's there. We also do next day forecasting for renewable energy plants to the same capacity. So those are some of the digital MRV capacities which are in-house with us, and this helps us provide an independent source of verification when these renewable energy plants go for issuances. So we already have this data in-house with us, which can then be tallied. That's an independent source of verification and part of DMRV. Similarly, in NBS, this is our latest thing that we have developed. We have developed something on the almost real-time, high-frequency forest fire alert systems. So for example, if you give us a polygon, if you give us the coordinates of an area of interest that you have, a forest, it could be an agriculture field, anything. And then we can track these forest fires on a 30-minute frequency. Like every 30 minutes, an alert will be issued whether there's a forest fire happening in this location or not. And this is like 24/7 into 365 days. And this will, you know, definitely try and reduce the monitoring cost, for example, in the NBS projects. So you need to have lesser amount of team with higher mobility. And then this is a satellite-based system. And this system can give you these early warnings. This is like actionable information. So it's like a 60-minute latency period between the actual incident happening on Earth and we getting a report on it. And every 30 minutes it gets updated. So those are some of the kinds of tools that we're developing. On a more generic note, you know, and what I would say is that, you know, this was mentioned by Dirk in the morning, as well as the Honorable Minister Grace also mentioned the point. Of course, our very own Andrea Bonzani also mentioned this point in his COP27 brief, that collaboration is the real key over here. You know, I mean, collaboration and cooperation. And I would completely agree with it and would like to repeat the point over here. In the technology space, I see a lot of competition happening. It need not be so. It needs to be much more collaboration and cooperation. There's so many data points that it's virtually impossible for any one agency or institution to start gathering them. It's much more about cooperation and putting in whatever you have into this larger pool so that the things connect using digital technologies. And then, we can create something wonderful, which is much more than what these data points are individually. Thank you.
Thanks, Mustafa. That brings me on to a point. We've heard that digital tools have the ability to kind of further and enhance price transparency to make markets more accessible to new market participants. At the same time, there's also the potential for markets to become increasingly fragmented, both either through competing layer one blockchains and kind of siloing tokens on that blockchain, or through pooling and having an abundance of different pools. Maybe is there somebody on the audience, on the panel, that would like to talk to those risks and how we kind of potentially mitigate against increasing fragmentation?
So given that you were looking at me that entire time, I'll take it. So at Flow Carbon, we firmly believe in a multi-chain world, right? That is going to be the future. No one chain is going to dominate. The benefits of tokenization are directly related to fungibility and liquidity. So if you have a layer one, a blockchain that the tokenization platform has not built a secure bridge that allows their tokens to be available across multiple chains, that token is not going to take off and is not going to be valuable to the market, and no one's going to want to use it. So at Flow Carbon, we have built our own multi-chain bridge. It's undergoing a smart contract security audit as we speak. And we've suggested to standards, as they're thinking about allowing tokenization under what guidelines, that it should be a requirement that you should have a security audit done by a credible smart contract auditing firm to minimize the risk of any types of hacks, for example. But over time, what you'll see, we think, is tokens that are available across chains broadly are going to be the ones that carbon credit holders want to utilize. And then you will have the liquidity that everyone's hoping for in order to get that price transparency.
And I guess if I can jump in as well, I completely agree with all those items. And the other discussion that's been coming up, and this ties a little bit to my discussion earlier around policy and regulation. The London Stock Exchange said they're interested in now moving into carbon, but what they also said is we want it regulated by the FSA as well. So ultimately, as you start getting scale, whether it's on-chain or off-chain, because look, there's going to be a variety of ways. There's going to be people that want to buy it analog, and they want to buy it digitally. It's just going to be different ways. But ultimately, making sure that whether it's retail or family offices or wholesale, I mean, if you think about it, credits can be used in so many different ways. I mean, if you're a large or a large commercial bank with a coal, steel, and fossil fuel exposure, your treasury may actually want to buy a large amount of those to put on your treasury's balance sheet as the equivalent of CDS as a hedge against the impairment around that. So as you start getting regulatory regimes looking at a security that's regulated like a security that's being done in volume, I think in that way you start getting that transparency. You get better price exploration because it's coming off of big over-the-counter trading desks. It's coming off of large regulated exchanges. So I think part of that moving into a larger scale regulated regime, you've got regulators watching, making sure what you're demonstrating is that those minimum standards as they develop over the next few years are being held to, that real regulators are making sure you're selling what you're supposed to be selling. I mean, it's not a carbon issue, but Goldman Sachs just got fined last week, the week before, for mis-selling ESG. It wasn't a big deal, it's $4 million, but at the end of the day, it's a big deal because ultimately, if you're mis-selling in a regulated environment, there are penalties to pay, there's reputational risk, and there's standards to be held. So I think there's a variety of things that come out of that, but certainly in scale, you get your price exploration and a variety of other things that come out of that as well.
Thanks, Michael. Maybe, Jacob, I want to turn to you at this stage. Aether obviously has given a lot of thought in terms of pooling and the value that pooling brings to carbon markets. Mm-hmm. Can you talk to that and also kind of walk the audience through the benefits of going through an on-chain pool versus leveraging CBL's NGO platform?
So I think the two aspects are not mutually exclusive. I think that actually we turned on to pools for a reason. As we're discussing here, Adam said it before, you can tap into a liquidity pool, which is not the standard one that you could find in traditional finance. There's, if we take a look, whether in a good, bad, or bad way, but to the blockchain space and the liquidity which has been brought on chain, not only I would say. And I gotta make this disclaimer, not only from 16-year-old kids around the world buying crypto, that's part of the game, but those are not the billions and billions which are on chain right now. Most of the largest investors are there. Some of very, very wealthy private family offices invested in crypto. Banks are now becoming custodians of crypto assets. So even regulated entities are starting to offer those services. And so there's a part of, I would say, the traditional finance, which up until some years ago we wouldn't have found it on chain, which is now on chain. And some of that finance is also looking for application which can stay inside a crypto environment, a blockchain environment, but also investing in products which have an effect in real life. And this is the case, for example, of pools. If you decide to tap into a pool to sell your credits, there's of course a number of advantages and disadvantages. Some of these disadvantages is you're kind of losing, I would say, not in all cases, but at least for the pools we've seen so far, some of the attributes. So, for example, the SDGs, some newer pools are now trying to identify those as well. But you become, let's say, more of a standardized instrument, similar to what you could see on actually regulated exchanges or unregulated exchanges in the voluntary market. But you're also tapping into a liquidity pool, which basically enables you to liquidate your asset faster, and therefore integrating this into a strategy, not as a single one, but part of a broader one, enables you to actually become a more successful, I would say, in that sense, project developer for a reason, because you not only you're leveraging a traditional finance, which you can do in any case, so both those being end users using your credits, companies wanting offsets, and then corporate social responsibility, or traders, but also the liquidity, which is, I would say, and allow me the term, in a parallel financial universe, if you want, which is also looking for ways to invest its money, and not necessarily, I would say, in monkeys, JPEGs, right? Which is often what we hear around. So I think that if we, as I would say, a legacy, traditional carbon markets give the possibility to such an environment to actually start tapping into the potential of carbon markets, I would say it's a win-win situation for both the crypto space and the carbon markets.
Thanks, Jacopo. I mean, clearly it sounds like there's compelling reasons to start bringing carbon on chain. And I think, Michael, you and I were both in the earlier panel around kind of the regulatory treatment or legal treatment of carbon credits. Clearly there's room for improvement in terms of legal guidance and regulatory treatment of on-chain assets. What, if anything, do you think the market should be doing or considering going forwards to scale markets with integrity?
No, and again, I guess I sound like a bit of a broken record on this, but I guess I'm talking my book, having come out of the BOE. But ultimately, what you're looking for is confidence in a market. And what regulation does give you is that level of confidence. Certainly, bankers are not saints, and they've certainly moved and broken regulatory rules over the time. But if you know what you're purchasing, and again, let's use carbon as a quasi-commodity. I mean, it's not corn or oil or gold where you can do a physical delivery if there's a breach of contract, because what you're really representing is a sequestration of 1 ton of actual carbon. But you can actually put insurance on that in the event that your forest burns down. Things like this are actually now insurance companies are putting that on there. So some of that regulatory regime, some of the financial service techniques are being brought into the marketplace. But where the regulation comes in is really around mis-selling. I mean, having that confidence, and we've talked about, look at integrity is at the end of that first sentence there, and making sure whether you're on-chain, off-chain, or any type, that you know that there's a minimum threshold of integrity tied to it, and if it isn't, There's consequences around that, and also around market behavior, market manipulation. There's a variety of things. It's a traded entity. It's a traded commodity, and there's manipulation all the time in those in variety of markets. So being regulated for those reasons gives confidence, whether you're a commercial buyer or ultimately if it can get to the point where it's retailer, family offices, things of that sort. You want to know that the people that are dealing in it are using proper dealing techniques, that what they're representing is correct, and if they aren't, there's consequences around that. So I think that integrity around a regulated market helps with the scaling, and again, as we've talked about here, putting the technology to work on this all of a sudden gives you that cost out and huge amounts of transparency. All that data that gives you that integrity is right there, and actually that's great for if a regulator wants to do an audit, they go right on chain and they see it right there, and you've got it. So I think consequently that helps build the market, build the trust, build the integrity in the marketplace for a regulated commodity.
And if I could just add in something here for a minute. It certainly would be ideal to have a clear, robust regulatory framework around crypto assets. Absolutely. That's not the world that we live in. So I think the decision that needs to be made is it worthwhile to enable the tokenization of carbon credits under very specific and credible guidelines? And what Flow Carbon, or do we want to hold back and wait for probably several years until you have that kind of absolute certainty? So at Flow Carbon, what we did as part of the consultation process is we gave very specific recommendations that we believe should give standards comfort that only really credible organizations that have put a lot of thought and money into figuring out, getting comfortable with what with the legal implications, the fact that it's not 100% regulatory certainty, coupled with a near real-time disclosure dashboard. So it's always clear to the entire world how you're matching up the tokenized carbon credits that you put on chain with what you hold in your custodial account, combined with smart contract security audits, combined with quarterly audits, public audits that are kind of publicly available to everybody. And we think that we can do this and enable the market to start really growing and unleashing innovation, accessing new demand in a very thoughtful and credible way.
And just one final thing to jump on there. So as I might have mentioned in my opening, is IOSCO is actually out right now for consultation, and those of you that haven't looked at it, if you go on their website for both the VCM as well as the compliance market, and they're asking questions about, so the standards may not all get nailed down in the next year or two or three, but if they get adopted, if IOSCO comes in and makes it a regulated security, that puts you into a fully regulated regime. So that's actually, those wheels are in motion, and I recommend anyone take a look at that. So that's a good step forward toward getting there. And to your point, a lot of the pieces of the puzzle are going to be outstanding for some periods of time, but at least being adapted by that, putting, is the documentation tied to them? So all of a sudden you've got something that's starting to feel like a proper financial security with the robustness around that is getting there. It's starting to move.
I have one clarification to make. It's not a provocation, Michael, but it's really something that I think could be useful. Like I agreed. I started my career in compliance markets in the UTS. So we went from an unregulated commodity with lots of problems, from fraud to CRs, double accounting, double issuing. I've seen basically all of it, and then to a regulated market, right, which has brought many benefits. But just different story on the voluntary market. Just imagine that from let's say tomorrow, all the projects that register need to go through a public chain, more than one, any chain that they choose, which is supported by the standard, by the registries, actual registries, and so the whole process needs to be transparent. There's nowhere to hide. There's nothing to hide. So project developers have no place to hide. And you say, well, right now you can upload documents, right, on the different standards. So you know how many projects which are actually live and lots of people are buying those credits from have the PDs which are outdated and nobody updates them because it's not a necessity. But if you do this on chain, you will always have someone saying, hey, what's going on here, right? Let's clarify this. Or the buyers would have the tools to independently see, hey, your PDD has been last updated in 2013. Yes, but the credit vintages are 2021. Yes, sure, update your PDD and then I'll buy your 2021 credits. This is not happening now. Sorry for the provocation, but I really need to be blunt. If we really want transparency, then let's go somewhere where no one can hide, right? There's nothing to be hidden here. So let's use a public chain. Let's go through a process of developing a project with all the steps being verified on a public chain. And regulation still necessary, but the enforcement of the regulation will be so easy that the regulators basically can sleep very, very cool nights. Right? Won't need to stress anymore. Right now, he needs to stress, and I do understand that.
And just to retort, I think we're not mutually exclusive here. I completely agree that the on-chain makes the regulator's job much easier. That said, market participants, having both been one for almost 30 years in sub-investment grade space, as well as being in the regulator side, you'd be amazed how creative market participants can be to ARB. So even though on-chain, some good regulation is not a bad thing. And they never sleep well, by the way.
Thanks, Michael. So we can kind of look to wrap up this panel. Maybe I'd like to turn to each of our panelists and ask kind of what's the one big innovation you're looking forward to adopting over the next 2 or 3 years? Maybe I'll start with Jack.
If there is something that I see speeding up a lot of the process, this is one of the other issues that project developers are facing right now, is probably digital MRV. I think digital MRV, which perfectly fits with blockchain technology, actually I couldn't see a better fit than this one, is, for project developer at least, a big step forward. It will facilitate not only the transparency for the buy side or investor side, but facilitate the job of both the registries and the standards as well as the project developers.
From my perspective, I think that the radically increased transparency that we're going to be able to see as all of this data comes online, as it becomes available to everyone who wants to participate in the markets, that is going to change the way carbon is viewed. So it's not just the people in this room, but the people outside this room who have less confidence in the carbon markets. Once that transparency is there and the accountability is there, that's going to affect the behavior of the project developers, it's going to affect the behavior of the regulators, it's going to affect the behavior of the market participants, and that's going to be tremendously positive for everyone in this space.
So I guess I would take in a similar vein, but slightly different take. I know right now there's significant backlogs at major standards because there's an explosion of interest, right, in registering projects. So wouldn't it be great if blockchain could help speed up that process, right, of project developers collecting information, submitting it efficiently to VVBs, VVBs efficiently auditing it, and then having an efficient process between the VVBs, the registries, and the project developers to just move through that backlog as quickly as possible. And I think that leads naturally to a kind of fully on-chain kind of process that leads to all the benefits that have been spoken about.
The one thing, the amount of data that's there, it's incredible. And I see that in the next 2 to 3 years, all this data will get much more consolidated. We'll be able to see a much more fuller picture because companies are coming together, collaborations are happening even as we speak, and these all data sets are getting connected to each other. Right now, we have a lot of, the interest in the blockchain is more on the downstream area where the sales are happening. This digitization process is going to speed up in the project development phase, as mentioned in the DMRV as well. So that's how the entire ecosystem is slowly getting digitized. And so entire chain starting point to the end point will be on the chain or on at least in the digital systems. So that's going to create value, that's going to create transparency in the market. That's what I see.
And I guess my last thing is, obviously we're talking about carbon and everyone here cares deeply about the transition to a more sustainable global economy. And so I commend tremendously Ethereum's moving and how they're changing, they're becoming less carbon intensive. So I guess my hope for the future and what I think hopefully will happen is a coalescing around whether it be chain or chain-esque type of technology, whether it's R3, whether it even be a centralized balance sheet that's more transparent, whatever it might be, to be able to have all the aspects we've talked about, the transparency, the auditing, and which we can do it in a highly sustainable, low energy type of way. So we're actually not just providing all the goodies that we need to make sure we've got a high integrity market that can be scaled, but also one that isn't part of the problem as well.
So I think at this stage, maybe it makes sense to turn to the audience and see whether you've got any questions for our panelists.
I'm Takashi Hongo, Mitsui Global Strategic Studies Institute. Thank you very much. This is a very, very interesting session. And may I have two questions, please? First question is, you talk about regulation is sometimes necessary, or flexibility of regulation is necessary, etc. But my question is, which country's regulator should regulate? So the project, location of the project and the place of the platform and buyer countries, or the many, many different areas. So which countries regulator should be regulated or provide a kind of control? That is my first question. And the second question is, you talk about efficiency and the speed up, it's a very, very smart way. So my question is, price the final buyer pay and the money paid to the project owner or the person who reduces emission. The price gap are there. If we are talking about the efficiency of the supply chain, the better to reduce the gap of two prices. Is there any instrument or is there any idea to reduce the gap of two prices? So I think that would be a very useful. If you can do digital carbon can do, that will be very, very effective for mobilizing a big amount of financing to mitigation projects.
So does anybody want to take a stab at that?
I'll take the regulation one. I guess I get it by default, but real quickly, every country is going to obviously conduct their own regulations, but there's actually, for lack of a better word, there's a climate regulatory incubator. It's actually called, it's not really an incubator, it's called the NGFS, which is a network for greening the financial system. It's a coalition, a collection of over 60 regulators globally. Every major country is in there, and it's a great place for these discussions. So what you would get is a coalescing around some basic baselines around regulatory, around this, and then each country would adopt around that. And there's some really good discussions going on. And again, I shouldn't be pimping the NGFS, but it is worth looking at them because they're doing some really great work on global climate risk. And there's some really deep thinkers in there. So that's probably where the regulatory work would come out of, and then each country would adapt it individually.
So I'm going to address your second question. I think that what you said makes perfectly sense, and it's also one of the biggest advantages of using a public chain and developing a project completely on chain, because you could really see what the cost of development is towards where the pricing of the final credit is. Right now, if you go on different platforms, and there's many around now, you can see the same credits from the same project being sold at 2, 3, 5 different prices. I imagine you live in Singapore, or you came from abroad? From abroad, exactly. If you fly in and you take 2 different airline companies, I'm just making an example, you can find the same exact credit being sold by 2 different airline companies with 2 different prices. How is that even possible, right? So it's not even 2 different projects, the same exact credits, which is kind of strange. But if you develop a project completely on-chain, leveraging blockchain, you can see exactly how much money is flowing to the project and where it's flowing, not only to the project developer, but potentially also to the communities, which is one of the biggest points here, money being invested in the communities first. And secondly, where the price point of the credit is. And if this price point changes, you will have the possibility to track this price point change across the inception, so from the moment on the credit is generated until it is retired. So you'll see the whole track. Right now, unless you track the markets and you have visibility on all the OTC trades or all the exchange data, you're not able to do that. But if a project is, let's call it blockchain native, you will have the possibility to do this. So analysis on price points will be way more precise.
just to add over there on the regulation part, something very interesting is happening in the 6.2 markets and the bilaterals, and we can maybe understand from there. So, I mean, for example, if you take the example of Ghana, right? Ghana has like bilateral contracts signed for the sale of carbon credits. So if you ask them which methodology are you using, and it's like, okay, they mention you the 3 famous registry names. Okay, we use one of these 3 methodologies. And then like, okay, but then who's the buyer? So they name a country. And then you ask them which methodology do they want. So it's like a matrix of 190 countries by 190 countries, deciding on which methodology to use. And that's the complexity, and the inspiration that you take from there is that they have already said that the methodologies from these 3 registries or something which is better than these 3 methodologies. So that's the threshold, and maybe that's an example from where the other kind of regulations might also take inspiration from, but that's how it's shaping out.
And the other thing I'd like to mention is that as it all goes digital and as it all goes on chain, it enables different parties to interact more directly. So being able to transfer a credit from me to you, I can do that directly, and the number of intermediaries required is radically less. And so that by itself, I think, will reduce that gap tremendously.
It takes the friction out of the system, which in friction is basically money.
Yes.
Hopefully that answers the question. It looked like we got time for one more question at the back.
Thanks very much. I was wondering how you view the mix of your clientele so far in your respective markets, and also your projections going forward more at, at one level at the APEC level, and the second at the global level. And on NGFS, I actually just returned from Japan where I met with Satoshi Ikeda, who's the Chief Sustainable Finance Officer, as I assume most of you would probably know. He's sort of their key person at COP27, and certainly at NGFS as well as a key part of the Japanese regulator. They are paying close attention to this, I can assure you, and we also have Singapore government representatives somewhere here. If there are comments as to what the regulators should do more of or do differently going forward, I'll be keen to hear that too, and perhaps we can make that happen. Thank you.
So, Michael, maybe do you want to start, given your experience of kind of both running an exchange and on the regulatory side?
Yeah, I gave some of the examples. Obviously, it's market manipulation, representation in the markets, standard compliance type of things that are absolutely necessary. A good way to think about this, again, even though you don't do physical delivery, is think of a hybrid between a commodity and a derivative, a credit default swap. And then what type of manipulation, what types of errors, what kinds of issues have come up in the market around that. And I think that's a good place to start for the regulators. But certainly the mis-selling, which is around, do you meet your standards? Are you sleeping well at night because you've got such an open blockchain that everything's apparent? But again, market manipulation and basically lack of standards are the first start on mis-selling of them. Additionally, around, again, even if you're demonstrating that you're going to deliver, so to speak, the sequestration, your ability to actually to do that, whether you've actually got the contracts and things of that sort, people are extraordinarily innovative in terms of trying to get around things. So despite the transparency of the chain, people are pretty clever. So I think some of the regulation should start there. And as the market develops, again, also price gouging. I mean, right now, because we have an unregulated market, there are people that are going into certain areas and literally putting a contract out, sign this please, to people in Southeast Asia and Africa. So there's regulatory protection around that, and then they're going out and selling them at huge gouging in terms of brokerage fees. So I think things around that also regulatory, as you move into a regulatory regime, a lot of that gets squeezed out as well.
Perfect. I think unless any of the other panelists want to chime in at this point, we've probably run out of time. So I'd like to thank you all for what's been a really informative session. And just kind of give a quick shout out to the Climate Action Data Trust, which we'll be launching in a few minutes. Hopefully many of you will come across to the plenary room for what I think is going to be a really informative session and a kind of quantum leap forwards for carbon markets in general. Thank you all.